So we are starting with question number 4 of fire insurance claim. The premises of ABC Limited were destroyed in fire on 14th of July 2018. The records, however, were saved from where the following particulars were available. Stock as on 1/4/17 is 50,000. Stock as on 31st March 18 is 70,000. Purchases 17/18 4,74,000. Sales 17/18 is 6 lakhs. Purchase from 1/4/18 to 14 July 18 is 1,62,000 and sales for the same period is 2,04,500. Purchase return from 1st April to 14 July is 12,000. Carriage outwards in June 18 is 4,000. While valuing the stock as on 31st March 2018, 4,000 has been written off certain stock which was a poor selling line. The cost of such stock was 9,000. A portion of this stock was sold in May 2018 at a loss of 500 on the original cost of 5,000. The balance of this stock was now estimated to be worth the original cost. Subject to this exception, gross profit had remained at uniform rate. So people, this is the new adjustment for this question. We'll discuss this. On 9th July 2018, goods worth 6,500 were received by godown keeper but were not recorded in purchases account. So this is as good as unrecorded purchases. The stock salvage was 15,500. The insurance policy was for 50,000 with an average clause in it. Calculate the amount of claim to be lodged with the insurance company. Now again, first of all, we always check whether the GP ratio is given in this question. No. If GP ratio is not given, we need to prepare trading account for the previous years. If the trading account details were given for previous 2 years or 3 years, we prepare accordingly. But in this question, the trading account details for the previous year is given for 17-18, so only for one previous year. So we'll prepare trading account for the previous year the way we did in the previous question. We'll find out gross profit ratio and that GP ratio will apply in current year's sales to find out stock on date of fire. So that will do that. This is your normal data, but now this is important. While valuing the stock as on 31st March 18, so while valuing this stock, that is 31st March 18, 4,000 has been written off certain stock which was a poor selling line. We'll do the adjustment for that. The cost of such stock was 9,000. So this stock must have been purchased in that year. So that will have adjustment for last year purchase also. A portion of this stock was sold in May 2018. So in this period, in the current year sales, that is April 18 to 14 July 18. So in this sales, this goods were sold at a loss of 500 on original cost of 5,000 and the balance stock was now estimated to be worth of original cost. Now what you have to do, we'll start basic posting first. We'll prepare in the books of ABC Limited trading account for the year ended 31st March 2018. So this is for the previous year 2017-18 and we'll prepare memorandum trading account from the first day of the accounting period, that is 1st April 2018 to the date of fire, that is 14 July 2018. So we'll start stock. Opening stock is 50,000 to opening stock 15,000. Next we have closing stock. Now stock as on 31st March 2018 is 70,000. So that is our closing stock. By closing stock, this will write in the inner column because there is some additional information given on that. We have purchases for 17-18, 2 purchases. This will also write in the inner column 4,74,000. I'll explain you why. Sales 6 lakhs. By sales 6 lakhs. Next we have purchase for 1/4/18 to 14 July 18. So that is your purchase for the current year. 2 purchases. In current year's period, your purchase is 1,62,000. Next sales from 1st April to 14 July 18, that is 2,04,500. So by sales in the inner column 2,04,500. Then we have purchase return from 1/4/18 to 14 July 18. So we needed to deduct it from this. So we'll write this in the inner column 1,62,000 less purchase return 12,000 and carriage outward goes to P&L account. So that will not come in your trading account. Now next, while valuing the stock as on 31st March 18, 4,000 has been written off. So this amount would have been after writing off that 4,000. That means the closing stock would have been 74,000, from which they have deducted 4,000 and then they have got this 70,000, because this would be after writing off this 4,000. They have say on 31st March 18, 4,000 has been written off of certain stock which was a poor selling line. Which was a poor selling line means on those stock the company might be assuming that they are not going to earn profit. That is of poor selling line, so company might sell those stock at cost or maybe at loss. So they have written off this 4,000, but we always find out our stock at cost, so we'll add back this written off. So add written off this 4,000, and now stock at cost become 74,000. So what we did, we just added back what is written off. If they say 30,000 is written off, you add back 30,000. If they say 3,000 is written off, you add back that 3,000. So that was written off. The cost of such stock was 9,000. Now what has happened? In this total purchases 4,74,000, we had purchased this 9,000 worth of stock, which is now a poor selling line stock, and on that we might be assuming that we are going to incur loss, and for that reason we have write off this 4,000. So if those goods which are included in your purchases, if those goods are not going to give you uniform GP, uniform gross profit, you should not include those goods in your normal trading account, because we have prepared this previous year trading account to find out GP ratio, and that GP ratio we are going to apply in current year's trading account. So we can apply this GP ratio if this is a uniform GP ratio which is applicable on all the goods, which we can apply on current year's sales. But on these goods, these goods are of poor selling line, and again if you see further, a portion of this stock was sold in May 18 at a loss. So these goods are not going to be sold at profit, rather they are going to be sold at loss. We can term these goods as abnormal goods, abnormal item, or you can say abnormal goods. Now what you have to do with this abnormal goods, wherever there is an effect of this abnormal goods, you reduce or deduct those effects from these items and will treat this abnormal goods separately, because when we find out GP ratio on this sales, we need uniform GP ratio, and if there are some goods which are not going to give you uniform GP ratio, or there can be some goods which might not give you same GP. For example, if your company is earning a gross profit of 20% and there are some goods which are sold at a gross profit of 10%, that should also be dealt separately, because if you find out GP ratio on this should be uniform on all the items. So in this case, wherever there are abnormal goods, you reduce those abnormal items from the normal items and treat them separately. So what we'll do, from closing stock we'll deduct less abnormal goods, and now the cost of abnormal goods is 9,000. Whatever the 4,000 was written off, we added back that to 4,000. So now in this 74,000, the cost of abnormal goods is 9,000. So we reduce 9,000 from this. So 74,000 minus 9,000, we get 65,000, and this 9,000 would have been purchased in the current year, or it can be the part of opening stock, but generally we see that opening stock must have been sold in the current year and purchase goods would be there in closing stock, like we follow FIFO method. So if we assume that these goods are purchased in the current year, these are the purchase of abnormal goods that should be deducted from your normal purchases. So less abnormal goods 9,000. So now you find out 4,74,000 minus 9,000. So this comes to 4,65,000. So now this is the normal opening stock. This is purchase of normal goods. These goods are not sold in the previous year, that is 17-18. So this is the sales of entirely normal goods on which we have earned a normal GP ratio, gross profit, and from closing stock also we reduce this abnormal goods to find out just the closing stock of normal goods. And they have also specified, subject to this exception, gross profit has remained at uniform rate. So except for this, your gross profit on entire sales, on rest of the sales is same. So when we have done this, opening stock, purchase, sales, closing stock, if there are any abnormal items, reduce those abnormal items from your normal items, and you can prepare or treat this separately. Abnormal goods, the cost of which is 9,000. So these are dealt with separately. You can even prepare columnar trading account for normal goods and abnormal goods. But rather than this, if the trading account is given only for 1 year and there is abnormal goods, this is more better and easier. So from this 6,65,000, we'll just deduct this to find out gross profit. We have opening stock. Okay, there is a correction. This should be 50,000. By mistake, I wrote 15,000. So 6,65,000 minus 50,000 minus 4,65,000. So this is 1,50,000 to gross profit. Now in this case of abnormal goods, the goods are not yet sold. So we'll just keep it as it is. We'll leave some space for this and we'll find out GP ratio. GP ratio is gross profit upon net sales. Again, in this case, sales return is not given, but still you remember as net sales into 100. So 1,50,000 divided by sales is 6 lakhs into 100. So GP ratio comes to 1,50,000 divided by 6 lakhs, percentage 25%. So except for these goods which are going to be sold at loss, these goods which were written off, we added back those goods. The rest of the goods are going to earn you 25% of gross profit. So that is your uniform GP ratio. Now we'll treat in the current year. Now what has happened of this goods in the current year? The cost of such stock was 9,000. A portion of this stock was sold in May 2018 at a loss of 500 on the original cost of 5,000. That means out of this 9,000 worth of goods, on the original cost of 5,000, the cost of 5,000 worth of goods are sold at a loss of 500. So these are sold at a loss of 500. That means your selling price for these goods is 4,500. And the balance of this stock, balance remains 9,000 minus 5,000 is 4,000. Balance of this stock was now estimated to be worth of original cost. So this is to be valued at cost itself. Sometimes they give the valuation for this balance of the goods, say 30%, 80%, 90%. Then you have to find out the value for these goods. If nothing specified, it is to be taken at cost itself. So out of this 9,000, some goods are sold at a selling price of 4,500 and these are sold when? In May 2018, that is in the current year, in this period, in this from April 18 to 14 July 18. So these abnormal sales, this abnormal sales of 4,500 is included in this. So we'll deduct that abnormal sales. Why we are deducting this abnormal sales? Generally what we do on this sales, we apply this GP ratio to find out gross profit and our balancing figure is stock on date of fire. But out of this sales, some goods, these goods are sold at a loss. So you cannot apply direct GP ratio on this amount. So we are deducting that abnormal sales to find out the sale of other items which are at uniform GP ratio. So less abnormal sales. From sales you reduce selling price of 4,500. So we get 2 lakhs. 2,04,500 minus 4,500. Last year's closing become current year's opening stock. To opening stock, you take this final figure 65,000 after reducing abnormal items. This we have done purchases less purchase return. From sales we have deducted abnormal sales. So if we see our question, while valuing the stock as on 31st March 18, 4,000 has been written off. So whatever is written off, you write back, add back those items. Cost of such goods was 9,000. So now this become abnormal goods. Reduced from closing stock, reduced from purchases. Portion of this stock was sold in May 18 at a loss of 500 on original cost of 5,000. So reduce that abnormal sales from your total sales. Balance of this stock was now estimated to be worth of original cost. So balance 4,000 is worth of this cost 4,000 itself. Subject to this exception, gross profit has remained at uniform rate, that is 25% itself. On 9th July 18 and our date of fire is 14 July. So few days before this, goods worth 6,500 were received by godown keeper but were not recorded in purchases account. So this is your unrecorded purchase. Now these goods are received by godown keeper. That means these goods are there in your stock where there was a fire on 14th of July, but these goods are not recorded in your purchases. So you need to add those goods. For example, if you had purchased some goods and those goods are not yet received in your godown and you have not recorded in the purchases, then there is no adjustment required, but the goods are not received in your godown. So what we always do, we find out physical goods lying at the place of fire, and these goods are there physically at the place of fire, so you need to add those goods to purchases, add unrecorded purchases, because you have received the delivery of those goods worth of 6,500, and then they have given you salvage and policy value. So how much is your purchase? 162 minus 12,000 plus 6,500, so 156,500. On this sales, now we'll apply gross profit. To gross profit, your uniform GP ratio that we have found out is 25%. So 2 lakhs into 25%. 2 lakhs into 25% is 50,000. We have opening stock, we have purchase, we have sales, we have gross profit. So balancing figure is our closing stock, and that would be our stock on date of fire. So 65,000 plus 156,500 plus 50,000. So that is 271,500 minus 2 lakhs. So by closing stock, this is your stock on date of fire. 271,500 minus 2 lakhs is 71,500. Finally, stock on date of fire. Now these are your normal goods on which you earn normal gross profit, 71,500. But out of this abnormal goods also, few goods are sold, but some goods are there in your godown. That means these goods must be there at the place of fire on 14th of July. So these goods are also lost by the fire. So you will file claim for these goods also. So you add abnormal goods also. Now since they have specified that these are worth of cost itself, you add the cost. Only in this goods, if they give you any valuation for the balance of the goods, you have to take the balance, because anyways these goods are abnormal. So if any valuation is given, you have to take the valuation. If nothing specified, you have to take the cost. So total stock on date of fire is 75,500. 71,500, that is your normal goods, but 4,000 is abnormal goods also, which were there at the place of fire, less salvage. Salvage is given as, the stock salvage was 15,500. So your actual loss, 75,500 minus 15,500 is 60,000. This is your actual loss, and the insurance policy is for 50,000 with an average clause. So you'll have to apply average clause. Now when you apply average clause, your stock on date of fire is 75,500, against which you have policy of only 50,000. So this is the case of under insurance, and you have to apply average clause. So applying average clause, stock on date of fire for 75,500 worth of stock, policy in effect is of only 50,000. So for actual loss suffered by the company of 60,000, because 15,500 could be saved, how much would be the claim amount? So cross multiply 60,000 into 50,000 divided by 75,500. So this comes to 39,735. This is your claim value. So guys, you understood this. Now this is very typical kind of question which you will see many places. In this question, what we did knew about the abnormal goods. Wherever is your abnormal goods, you just deduct those abnormal goods. So first of all, if it is written off, you add back. Then you deduct abnormal goods from your stock to find out just normal goods, because we need normal GP ratio. If these are included in your closing note, this must have been purchased during the year. So reduce from purchases also, find out normal GP ratio. If those goods are sold in current year, you deduct those sales also, because these goods are sold at loss, and we cannot apply 2,04,500 on this. We cannot apply 25% gross profit, because we have not earned gross profit on entire this sales. Out of this, we have earned profit on only 2 lakhs worth of sales, on which we applied gross profit. There is no extra purchase of abnormal goods in the current year, so no effect on the purchases. This is just unrecorded purchase, the goods which were received but not recorded. We need to add those in the purchases. We find out closing stock. Again, this is important, that when you find out stock on date of fire, you take both normal plus abnormal. They have specified abnormal should be valued at cost, so we have taken cost only, less salvage, and now this rest of the same, applying average clause, and you find out the claim. So in this goods, this abnormal goods treatment was the new item which we have not done in previous 3 questions. Okay, so I hope you understood this question. If you have any doubt, you can ask in the comment section below. Thank you.